Welcome back to What's Hot and What's Not CRE, your daily pulse on commercial real estate in America. It's Thursday, January 15th, 2026. Today we're breaking down which multifamily class looks strongest heading into 2026. Class A, B, or C. The data tells a clear story. Let's get into it. First up on What's Hot. Class B workforce housing is the clear winner. It's outperforming across the board. While the national vacancy rate sits around 8.5%, Class B properties are holding up strong with better occupancy, healthier renewals, and steady leasing velocity. Renters prioritize affordability, and Class B hits that sweet spot. The deeper renter base translates to more durable demand. Secondly, institutional capital is flooding into workforce housing. The affordability crisis is structural. Homeownership remains out of reach for millions. Millennials and Gen Z are delaying purchases due to cost. That's pushing sustained demand into Class B rentals. Institutional investors are committed to multifamily in 2026, and workforce housing is their primary target. Value-add plays in Class B offer compelling returns through operational excellence and light renovations. Third, and here's the key insight, Class B will outperform on rent growth. Workforce and mid-tier properties are expected to outperform luxury assets on rent growth in 2026. While national rent growth forecasts hover around 1 to 2%, Class B in supply-constrained markets will beat that. The Midwest is leading with more balanced fundamentals. And fourth, the new supply pipeline actually favors existing Class B. Roughly 450,000 new units are expected to deliver in 2026. Down 45% from the peak. But here's the thing. Developers can't build Class B economically. New construction pencils only as luxury. That supply constraint protects existing Class B assets. Now for what's not. Topping the list, Class A luxury is still struggling. 4- and 5-star properties saw rent declines averaging 0.4% in 2025. It's a tough environment. Luxury units are competing hardest on price and incentives. Concession use remains high. Standard amenities no longer justify premium rents. Properties need unique experiences to command top dollar. Stabilized vacancy in Class A remains above pre-pandemic levels and won't normalize until 2027 or 2028. Next, the Sunbelt Class A faces the biggest headwinds. Markets like Austin, Phoenix, Nashville, Miami, and Orlando have significant supply overhangs. Conservative rent growth assumptions are absolutely essential here. Submarket dynamics matter more than ever. Blanket Sunbelt exposure is risky. And finally, Class C carries serious execution risk. Class C looks attractive on cap rates, but comes with elevated expense ratios, insurance cost spikes of 25 to 40%, and higher bad debt. That economic sensitivity is real. Any downturn hits these tenants first. Capital access is also limited. Only experienced operators should play here. So, why does all this matter? The multifamily market is gradually recovering as new supply slows, but it's not a uniform recovery. Class B workforce housing benefits from structural demand drivers, affordability challenges, delayed homeownership, and a deep renter pool. Class A is working through oversupply and concession burn-off. Class C requires specialized expertise. For risk-adjusted returns in 2026, Class B is the institutional consensus. So here's the investor takeaway. Buy Class B in supply-constrained secondary markets, especially the Midwest. Target value-add opportunities with operational upside. Avoid new Class A and oversupplied Sunbelt metros until concessions clear. And approach Class C only with very strong operational capabilities. Class B workforce housing is the sleep-at-night trade for 2026. That's your Thursday class breakdown. Class B wins 2026. Thanks for tuning in. See you tomorrow. Don't forget to like, share, and subscribe. Visit hotnotcre.com to learn more and subscribe to our newsletter.